everybody, welcome back to the Idiot Investor Guide channel with your host Guy Davidson. Today it'll be episode number 4, starts with both hands, that's 8, episode number 4 of my Sharesies portfolio, updating you on changes I've made and unfortunately the losses of the last month. So I'm still up, but I've lost significant gains since last time, and that's all due to one big player that we all know I'm invested in. So I'll take you through that and what changes I've made to the portfolio, and hopefully it's pretty much there now. I don't think I'll change it much moving forward, although in saying that I've changed it every fucking week, so we'll see if I do actually stick to that, but it should be pretty set in stone now. I think I've got my funds and I've got those individual stocks I want, and I'll sort of explain why I'll be keeping it like that. So let's jump into it. Here we are. We're in here almost at $6,000, and it was actually above that number. You can see 11% return is still good, $600, but at one point I was up $1,000, more than $1,000, about 20% plus returns, and you can sort of see it there. So I was up at $1,000, started June, and it's all sort of come backwards since then. And that's in large part to do with my heavy investment in New Zealand. Firstly, through the funds. So true to my word, I'm selling my NZ property fund. So again, thank you, Joseph Clark, for pointing that out. And sorry I got your name wrong in the last video. Made sure to get it right this time. So I got my dividend from the NZ property fund. I was waiting for the dividend payout, and then I was planning on selling the share. So I've got a limit sell on. I believe I've put it at 1.3 as the limit sell. So hopefully we get back up around that number. I'm not in a hurry to sell it, so I'm willing to wait. It might be negligible. I probably should just sell it anyway. But anyway, I've got it on there. That'll last for a month. So we'll just see how that goes. I'm not in any rush to sell it. The other 3 funds, the emerging market, top 15 US large growth, I've still just been chipping away. Auto investors playing a big part now, so the dollar cost averaging for that is working out really well. Up probably what you'd expect due to the current climates, so 5%, 3%, and almost 3%. These two would expect to sort of sit around 4 to 6 maybe for the next wee while, but long term I'd expect to see them up around 8 or 10%. I have no idea with the emerging markets. I still no idea. It's still a bit of a hedging gamble play. We'll see how it turns off. It'd be nice just to have 4 funds though. In the phone it will be like a perfect square. I'm a bit OCD, so that'll be nice for me. And on the companies, so we're keeping this real simple now. You can see my Seeker's still on the sell order because I had put it at, I think $4, 4.38, I think is what my sell order's for, which is looking unlikely for the long term. I'm not in a rush to sell. You never should be in a rush to sell your stocks because you can lock in a loss. So if this takes a while to sell, it's fine. I'll just hold on to it. I do think that Seeker will do reasonably well long term. I just don't think it's going to be a really high growth stock. So that's why I'm selling it, not because I don't think it'll be a successful company. I'm selling it because I think it's in the dangerous middle ground of higher risk, not huge reward. And I could be proven wrong. So maybe this is a blessing in disguise. Delegates storming, actually. They're doing really well at the moment. This is one that I said on the previous video that there's unlikely to be a high chance of high growth. It's dangerously middle ground, but I wanted to hold it anyway because I think it's a good company, and it's got some really good brands, Oyster Bay being one of those, and Barossa Valley. So, it's decent company. I'll continue to hold it. I don't know if I'll invest more into it, but I'm just interested to see where it goes and how high they can climb. The true screen gamble play, the YOLO. It's still at 10%, sort of bounced around 10 and 12% over the last wee while. I wouldn't expect that to make any serious moves until all this COVID stuff's over. if it does ever make any serious moves, but I'm committed. I'll leave what's in there and just see if it does come off. Then, of course, we've got the main culprit that's dragging my portfolio down at the moment in New Zealand. So, in New Zealand's dropped away significantly over the past month, more or less. And I've been taking advantage of that. So, instead of selling as it going down, I'm actually buying. So, I'm getting it cheaper. And my thought process was basically anything 1.5 and below is likely to, in the long term, double, because it used to be around 3 pretty consistently in the past. So that's why I bought back in at 1.5, put a limit order at 1.5, only $100, and then the same at 1.3, I believe. And then I've put another purchase order on at 1.2. So if it gets down to 1.2, which is doing a bit of a resurgence, so it might not, but that's sort of my thought. I'm not going to put too much more into in New Zealand. If you go and watch my latest Hatch portfolio update, David Kelly has given me some pretty sage advice on not investing for dividends while you're younger, because you actually in New Zealand get taxed on your dividends because it's money you're earning, whereas you don't pay capital gains tax on the growth of stocks. So that basically means if you've got a stock that's increasing in value significantly, you don't get taxed on that. I think there's a certain time frame, like if you sell it really quickly, then you can. But if you hold it long term, you won't get taxed on that in New Zealand currently. And I think that's a better tactic to follow for a young person, is to go for the high growth ones rather than the dividend portfolio. In New Zealand has the potential to sort of 2x the money. So that's why I am doing that right now, is I want to look at, doubling the money that's in there. The dividend was really attractive to me as well, because in New Zealand historically has paid really good dividends. Dividend yield at the moment is 11%. They're normally, I think, around 8 or 9% when it's not this crazy time. So that was quite attractive to me about this as a long-term hold. I might reduce how much money I have invested in here once it does get back up to historical levels, purely because of that whole conversation around getting taxed on dividends. So yeah, watch the space. But for now, I'll put more in if it continues to crash, for sure. But I'm not going to be investing a whole lot more money into it. I really just want to wait until there's US shares and Sharesies, and then that's probably where most of my money's going to go, because in my mind, that's where all the really high growth stocks are generally in the US market. So that's just a quick update for you guys on my Sharesies portfolio, episode 4, not 8, episode 4. It's under 10 minutes. What a treat for you guys, not even trying to work the YouTube algorithms. If you didn't know, by the way, the reason why people make 10-minute videos and longer is because supposedly it helps the YouTube algorithms say this is a more important video. I think because longer videos are normally more educationally focused or something, like it's teaching you something. So anyway, that's why people make longer than 10-minute videos, is so hopefully their video gets promoted a bit more. There's a bit of a under the hood unveiling of some of the inner workings of a YouTuber mind. But this one I'm just keeping short and sweet. I could probably just keep rambling on and drag it out, but I'm going to purposely keep it under 10 minutes just to show you guys I'm not always going to make videos for the algorithm. Watch out for my Hatch Portfolio 4 journey. I don't know whether I would have dropped that before this video or after, maybe after. And my investing $10 a week into Sharesies portfolio journey. And my first stake one, number 1 stake. I'll shut up now so that I can keep it under 10 minutes. Catch you guys on the next one.